Time out. You do not need to invest to make money. Let me explain. We've been programmed to think that that is the way to do it. Just like we're programmed to know that we go to work and we have to earn to make money to do the thing before investing. See, that's all conventional wisdom. And there's a lot of reasons, there's a lot of influences on us telling us that that is the way to do things. Look, go to the corner. There's probably 4 banks on that corner, and they really want you to conform with what this system wants from us. And that is to keep staying on the treadmill, to keep staying in the rat race. There is a different way. You can use contracts. You can delegate the responsibility of growing your wealth to someone else, a major financial institution, in fact. And it's no secret. It's not really a surprise. It's just not really shared. You could have been doing this for the last 200 years, in fact. The contracts that I'm talking about here have been available for that long. So it's certainly not a secret. It's just not well known. That's the problem. And that's what you're going to learn today. By the end of this video, you will understand why your current strategy with your personal finances is destined to fail, and how a simple shift in the way you see things and the way you interact with your money is going to completely transform your future. I have been in the real estate space for so long. I'm an investor, and you probably have considered real estate investing as well. Like, it's been the holy grail for so long. Yeah, until now, when liquidity is not great. Prices haven't really appreciated the way that we were accustomed to. And it's just caused me to rethink my strategy and the sequence in which I go about acquiring assets. And here's what I really discovered. Timing really helped me out. I got very lucky, very fortunate with the real estate market and an upswing for so long. It's been fantastic. I have no complaints. But when the tide goes out and a lot of real estate investors are stuck there naked because they don't have the support, they didn't plan for what can go wrong, they could be left with the reality that they've got to sell all their assets. And that's not something that any of us want for anybody. It just helped me get some clarity on why we do the things we do. What is the right way to go about building wealth? So you can put your money in the real estate, you can put your money in the stock market, whatever you want. But know that what you're doing is you're hoping that it goes up, right? It's a bit of a gamble, isn't it? You're hoping that the price is going to appreciate. Now, historical results say that it's probably going to be true, but this is your money we're talking about here. Do you really want to go in on hope? Or if you were offered an alternative, a contractual obligation that you can impose on somebody else who has to grow your wealth for you. No risk, no questions. You have to do this. One seems like a safer bet than the other. I'm going to explain all that now. All right, there are really 3 big problems that I think many of us experience when we're talking about our wealth and how we approach building wealth. And more importantly, why we don't build wealth. You know, the great Albert Einstein famously is on record saying that compounding is the 8th wonder of the world. So little effects that create growth over time create amazing results is the point of this. Compounding in this case is compound interest, compound growth. And quite simply, what it means is you need to put money into something, into an asset that's going to grow and allow it to grow. Stop interrupting the compounding. The problem is we don't do that. Here's what I mean. There really are 3 types of money personalities, if you will. First, you got the savers. Here's what the savers do. When you've got an expense coming up, or you want to acquire something, you know about this in advance. And what you do is you save little by little, just like a chipmunk with nuts. You put them away, you put it away, you put it away, you put it away, and you just keep building that up till you finally get to that plateau where you have enough to do the thing you wanted to do or buy the thing you wanted to buy. Now what happens? You spend it, poof, it's gone, and you're back down to 0. Right? So savers do that. They do not allow for compounding. The minute they have enough, they've reached their goal, it's gone. Let's look at the opposite of that. Borrowers. Borrowers can't wait to spend that money. So Instead of saving up for it to get it, they borrow the money to get it right now. And what they have to do is they got to pay back a loan now. What they do with their money, it goes back towards paying back loans. And they hope to get back to square one, back to zero, so that they can free up more money and they can borrow again. Bottom line for them too, they're always back at zero. They too never allow the power of compounding to impact them positively. What you got on the very other side now are called wealth builders. I call them wealth builders because they are wealth builders. And what they do simply is they just grow their wealth. All they do is put money into a growing asset, into a contract, and that contract guarantees that it has to grow. And they don't interrupt that growth. Just that one change is massive. Mistake number one then, people just do not harness the power of compounding. It's not difficult. It is not difficult. It's very simple. It's just not easy to do when you've been trained to earn and spend and earn and spend. Second mistake that many of us are making is we are playing a game designed to benefit very few, those in control of the monetary system. I'm talking about banks and governments. Really, it's rigged, right? I'm not saying that they've done this as a conspiracy where they're trying to really stick it to you and manipulate. It's just evolved into this right now. It is a game and it's rigged to get you to fail. You can't win. Don't believe me? It's straight math. Think of this scenario. When you deposit money into a bank, what happens with that money? Well, the bank then takes it, says thank you, and agrees to pay you this tiny amount of money. And they'll go take that money and they will multiply it many times over. Then they will go and lend it out to people that want money and they will charge them a significantly higher rate. They're not putting their own money at risk. They're putting your money at risk. They lend yours. They don't have cash. They have your cash. They're benefiting from your dollars being at work, not you. That happens all the time in Canada. And when they get into trouble, all they got to do is call up Canada and Canada helps them. So it's an amazing business if you're a banker, not so good if you're one of us. Another thing, think about this example. This is what inflation does. Let's say I have this pen, and this pen, I bought it for $1,000. Over time, this pen hasn't changed. In fact, it's probably been used and abused. It's a lovely pen. But in time, this asset appreciates with inflation. It appreciates because of inflation. And now the cost for this thing is like $5,000. It hasn't really changed. It's not worth more, but the amount that you need to pay for this has gone up because the price of everything has gone up. Inflation changed the value, not the actual thing. Well, guess what? The government sees this as an increase in value. They increase the price of things because inflation is part of monetary policy. Don't get me started. But the fact that this went up in value on a spreadsheet means that I have a taxable gain. I have to report income of that $4,000 and then pay income tax on that $4,000. This system is not designed to benefit us. We're playing a rigged game and we need to stop. And the last large mistake that I can see, you've just been trained to save what's left over, right? So we get paid, we do a job, we get paid. Before we can even see our money, got to cover income taxes and all the EI and CP, all the expenses that come along with being employed. Before it even makes its way into our account, we have to give away our money. So we only see what's left over. From that, you got to pay for things. So we pay for things. Pay for the car, pay for the kids, groceries, whatever, the home. And then with what's left over, we're meant to save that. So we focus on, we're going to try and achieve a savings goal of 5%, 10%. And we're trying to grow this small number into a big number. How? By investing. And we just said investing comes with risk. It's hoping that it's going to increase. So we're taking a small number, we're doing this. Why don't we change the way we look at things? Why don't we look at the big number first and see, how do I use this before I just consider using this? The mistake is we're always looking at this. We're going to change that in this video. Since I love math so much, I created a little diagram that I want to share with you. We're going to compare savers, okay, just like people that take no risk at all and just want to save their money under a mattress or even worse, in a bank account. Then we're going to compare those guys to typical investors. And then we're going to compare that to people who are using the strategy that I'm talking about, which is using contracts to build your wealth, putting the obligation on someone else to grow your wealth for your strategy. So here are the assumptions we're going to use. Savers, the money that goes in the bank account, you're going to earn 1%. Investors, you're going to earn 7% in rate of return. 7% interest or rate of return, however you want to call it. You're going to be growing your value of your money by 7%. But you're also going to be paying taxes of 25% in this example on the gains. Okay, that's the investors. And the last section, we're talking about obligation creators is what I call them. They're going to use contracts and they're going to contract with somebody else to grow their wealth by 6% per year. Now, just to level set, everybody here in this example, they're all contributing towards the savings or whatever you want to call it, $10,000 per year for 20 years. I'm also going to build in, let's just say you're going to be facing some major expense every 3 years, and it's going to cost $15,000 a year. So savers are going to access their money from their savings, the $15,000 every 3 years. Traditional investors are going to access their $15,000 by selling some of their investment. And my obligation creators, they're going to be accessing their money through their contract as a loan against the value of the contract. And I'll expand on that as we go into this video. But just know that they are not interrupting the growth of their asset because they are allowed in their contract to have a loan side by side with their assets, and they can borrow money rather than use their own money to pay for their expenses, so long as they pay it back. And when they pay it back, their interest rate for those guys is 5% per year. And part of their $10,000 annual payment is going to go towards paying back those loans. All right, the blue line is a typical saver. And you can see they go up, they go down. It's almost like a zigzag across. They save more money than they're spending, but they're still not really coming out further ahead. Traditional investor with a 7% annual return, on average, with a 25% tax on the gains, they're above the savers for sure because they're getting better returns. And even considering that they're paying more tax, they still come out ahead of typical savers. So definitely don't save. But look at the obligation creators. That is a wealth builder chart. That graph, that gold line that is skewing up like a hockey stick, that is the power of compounding. These results are showing you what the net is after you increase and you have to pay back. That is the net. All right, this is the net growth to the person under the same scenario. Everyone's pulling out $15,000 every 3 years for an expense, including the wealth builders. This is the difference though. Look at that chart. Like just fast forward, okay, in 20 years, what happened here? Everybody paid $200,000 in total, $10,000 over 20 years. And everybody used $15,000 for some major expense every 3 years. It's same across the board. What's not same is their strategy and the way they interact with their money. Savers, would you look at that? They're left with $55,346 in 20 years. They put in $200 and they accessed all this money for expenses, but they're now down. They're down almost $145,000. And most people fit into this category. Then you got traditional investors. Again, they paid the same $200,000 over the 20 years, and they're left with $117,000 in cash value in 20 years. Better, but they still lost money. They still lost $82,000 over the course of the 20 years. And would you look at that? My obligation creators, they contributed $200,000. They have $300,000 and they've paid for all those expenses along the way. Even better, as we'll discover, they took on no risk. They didn't have to pay a lot of their gains and taxes. They have figured out ways to access liquidity and so many other benefits. We're going to get into that. Bottom line, math speaks for itself. These results are amazing for obligation creators, and I think a very good example of the differences between what most of us are doing and what we could be doing. And look, you're doing everything right. You're doing what everybody says you should be doing. Save, save, save. You cannot save yourself into prosperity. Just like you can't tax a country into prosperity. To me, they're very similar. Both of them don't work. So just want to make sure that you are mindful of options beyond just what everybody has been doing. I want you to understand how a consumer thinks, and then I want you to see what contractual thinking could do for you instead. We have been conditioned to think like consumers because we are playing in a rigged system. It's a rigged game. We earn, we save, we spend. And the cycle repeats over and over again. Money is something to spend or save. This is how consumers think. The goal is to accumulate enough money to feel secure, and it's not working. There's another way of thinking that beats all this. It's contractual thinking. Thinking in terms of contracts, thinking in terms of putting my problem onto someone else, creating an obligation to them to give me the goals that I want. Contractual thinkers know that money is fuel for creating contracts. They use other people's money to spend, not their own. And what they do is they create contracts to obligate others to pay me. The goal here is to maximize the obligations that we're putting on other people. Who are other people? Massive financial institutions. And it's not a secret. It's just not common. When you shift from consumer thinking to contractual thinking, your whole life's going to change. Can we go through an example so you can see this in action? Why not, right? Hey, look, you like going on vacation, I imagine. You've been on a vacation before? Perfect. Who doesn't love to vacation? So part of being human means that you kind of want to go away and explore, have some adventure. All right, let's just say that you've committed to going away at least once a year. All right, you and your family are going to go away every year. You're already doing this. And let's just say you are budgeting for $10,000 per year in this example is your vacation budget. So how does a typical consumer-minded approach work? Okay, well, you look at it and say, all right, well, I've got 10 grand to make up so I can go on vacation next year. I got to save for that. So I'm going to turn into a saver here. So I save. And saving means each month I'm going to save 1/12 of that, which is $833 towards the $10,000 that you expect to need on vacation. All right. 12 months later, you saved up 10 grand. You might have made $30 in interest at the bank while you were saving, all taxable. So it's not $30, but doesn't matter. You have $10,000, you go spend that money, go on vacation, and you're back to zero. And then next year, you do the same thing. Otherwise, you don't go on vacation. That's a typical consumer-minded approach to how we vacation, probably how you vacation as well. And there's no judgment. This is all we know. Consider an alternative. All right, let's change the way that we plan for a vacation. Next year, when you go on vacation, you're still going to need $10,000. You're still going to have the same vacation. We're just going to change the way you save for it. I say save, but you're going to change the way that you plan for it. You are going to create a contract like I described in the Money Mansion. You're going to create a contract and make it someone else's obligation to grow your wealth. What you're going to do is you're going to fuel that contract the same way. Instead of saving $833 a month in your savings, you're going to divert those dollars to the contract. You are going to add fuel to the contract, $833 a month. Right? At the end of your year of contributing, you're at $10,000 as well. Here's what you're going to do because we have the right in our contract. We are not going to stop the growth of our money. Our $10,000 is going to forever grow and compound. What we're going to do instead is say, I would like to take a loan out from my contract, I'm allowed to, for $10,000 so I can pay for my vacation. So I ask for a loan separate from the growth of my money. It's another layer. $10,000 in a loan, I take that and I pay for my vacation. Following that, I'm not saving $833 a month next year. What I'm doing instead is making that payment to pay back that loan. Okay, so I'm paying $833 a month towards that loan. There will be some interest, but it's not going to be significant because with each payment, I'm reducing how much my loan is, which is reducing how much interest I'm being charged. No big deal. The difference is this. At the end of the first year, I will have $10,000 still in my asset even though I went on vacation, because I chose to do it this way. And that $10,000 will become $10,500, which will become 11, which will become 15, which will become $25,000 over the years, because it will compound in the contract. The family who went on vacation just saving and paying every year, they're going to be at zero forever. It's just the way we know how to spend. I'm proposing you change the way you see how you spend, use contracts. One simple change in how you see money. So we're going to change the way we see money, right? It means this. We need to stop chasing returns. The investor thinks returns. He's always thinking about, well, what's this return versus that return? And when you get together with a buddy, you start bragging about how you have a higher rate of return than this person. The wealthy aren't talking about returns. They don't care. They're talking about obligations. They're talking about contracts and how they've created obligations on someone else to grow their wealth. They're thinking way bigger than these traditional investors, constantly chasing returns. And guess what? You're never going to win. Fundamentally, gotta stop chasing returns and start chasing obligations. How do we obligate more and more people, more companies to do what we want them to do for us? The solution, like what is the contract? Well, I get into that really extensively in my book called Get Wealthed Up, How to Build Your Money Mansion. So the money mansion is just this conceptual framework or this conceptual object that I use to discuss the contracts that I'm using to build wealth. There are truly 6 fundamental elements to creating that contract. We're going to just design the perfect contract to obligate someone else to create wealth for us. What would that contract look like? What are the key elements to that contract? And here's what I've determined. I want contractual growth, tax efficiency. I want there to be a liquidity mechanism to access money. I know that the partner is going to generate money for themselves with my money. Well, I want to profit share with them. So profit sharing. I do want legal protections. Not that I'm shady, but I want to protect my wealth from this litigious world that we live in. And I would say almost even most important, I want this framework to work for multiple generations. I would like my wealth to be passed on to my kids tax-free, efficiently, and I want them to be able to do the same thing if they want to forever. All right, so we could try and re-engineer and build a contract that creates these rules. In exchange, obviously the partner we're contracting with and obligating to do these 6 things for us will expect something in return. It has to be win-win, otherwise this is not sustainable. Well, win-win would mean I need to do something for them. So what my offer to them is I will contribute money to this every year. Because to me, that money is not investing, it's not savings, it's fuel for this contract. It's fuel for my wealth. So it's definitely a mind shift, right? We're not talking about investing. We're not talking about like that side of things and rates of return. Doesn't matter. What we're talking about is I want these 6 things and more. And in exchange for that, here's what I will do to make this contract make sense for you. Here is the thing. We don't need to re-engineer a contract. We could just look in the market and figure out what can we make use of that already exists. And you would be surprised to know that there is a framework that we could already use. We can modify it and we can tweak it, but we don't have to reinvent the wheel, which means no lawyer fees, none of that stuff. It's efficient off the bat. I need to emphasize, because we live in this world where it's always about the asset. Well, this house is performing better than that house, or that S&P index is doing better than this Apple stock, or whatever you want. We continue to compare returns. We need to stop thinking about the actual asset. It's the strategy that's going to make all the difference in the world. So if we strategize how to create contracts so that we can get the results that we want, well, the strategy is what matters the most. Right now, it's a matter of plugging in some holes with things that fit. And none of it has to do with real estate, stocks, bonds, T-bills, nothing to do with any real element of risk. Now, can you do that with anything? Yeah, If you drive a car and you've got car payments, okay, well, it's the same concept. If you're saving up to buy a car, you're saving up for a down payment or whatever, you could, rather than save up, spend, go back to zero, you could change your approach, stop being a saver and a borrower directly, and start becoming a wealth builder, layering in the spending side of things, layering in the borrower side. The point is, your money continues to grow. Your money continues to compound. That's a shift. Right? I'm talking to you about borrowing money rather than using your own money. And that's going to be very uncomfortable for a lot of people. But if you don't do something different, you're bound to find out when it comes time to stop working or retire, you just are not going to be okay. That's my fear for all of us. We're just not going to be okay. Change the way we approach our money. Stop thinking like a consumer. Start thinking in terms of contracts and obligation. Now, this will take time, but it is unshakable. There are guarantees littered in the contracts. I'd be happy to show you how. Look, ultimately, the goal for all of us is to get to that point in life where you're no longer working or you've chosen to no longer work and you just want to be able to do things with your life. You finally got to the point of life where you can do what you want to do. You have the time, while you're still fit, while you're still able. Okay, well, how do you pay for that? Well, a lot of us are not going to be able to. Consumer-minded people are not going to be able to fund an amazing last phase of life. Just can't. The system is designed to make sure that you are dependent on that system. Continue to feed it. Think about your RSPs, for example. Your RSPs at some point will convert into this thing called the RIF, R-R-I-F. And a RIF has to be withdrawn over the years. It has to be. You got to keep depleting the account. Well, if you keep depleting the account, at some point, that account's got to get to zero, right? So the cost of things are increasing. You keep taking money from it, it's going to end up at zero. I mean, that doesn't inspire a lot of good feelings about the future. So the entire thesis behind the money management is to get to the ultimate end game of this golden goose plan. Now, what's a golden goose? Like, you've had these talks for sure with your buddies, and I want to have enough money so that I can put it into an account and generate interest, and I can live off the interest. That's the goal. Well, a golden goose in this analogy would be like your account is the golden goose that lays golden eggs, and your golden egg is the interest. So you're living off of that. The goose survives. You just keep taking the eggs from the goose, and you're never going to need any more. Now, think about how far-fetched that seems when you really consider what I said about inflation, what I said about how the world's getting more expensive, how the system is kind of rigged against us. That mathematically, we cannot defeat that system if we play by their rules. Well, then what does retirement look like? Are you going to rely on a pension? Who's got a pension? Like, do you have a pension? I know people I speak with, the majority of us do not have a company pension. Okay, you've got Canada pension. Great. What is Canada pension going to give you? I see my parents. I see my in-laws. It's not a lot of money considering what it costs to survive and live somewhere and rent and that. None of that stuff works. The Golden Goose plan is the ultimate end game from the money management. And how it works is this. Over the years, you started your money management when you're still earning. You contribute every year. You are adding fuel to this. Well, that account just keeps growing and growing and growing, right? Like compound chart again. It just keeps growing. When you're at the age where you're ready to stop working, whenever that is, because it could be early, you got enough momentum in your account that it keeps growing, the annual increase is actually going to be far superior to what your spend will be. So what you're going to do is you are going to create that layer where you have a loan, and instead of taking income, which is fully taxable, you're just going to take a loan against the value of an asset that is continuing to grow. The loan and the interest, you're never going to pay back. And I explain how in the book. You're never going to pay it back. What you're doing is you're just building and building and building a loan balance that you're using to survive. And your account is growing faster than what you're using from the account. Let's use an actual real life example of a golden goose, shall we? And we got a case here where client, Jonathan, not his real name, but his Jonathan. And Jonathan set up his money mansion. And his goal was ultimately the golden goose. He's 45 years old and he's contributing $100,000 every year as fuel to his contract. And he's going to do this for 10 years. The way we have structured it, 10 years, he's done. So he would have contributed $1 million over 10 years, which I understand may be a lot of money for some and not a lot of money for others. Just to understand the point here. $100,000 every year for 10 years. That money is expected to grow consistently. Like I said, it's under contract. It's going to grow consistently, never have a down year because that's not allowed, only go up. So at 45 to 55, he's funding his money mansion. Between 55 and 65, he will do nothing. He's not contributing anymore. He's decided that he doesn't want that for his plan. And he's decided to execute on the golden goose. 10 years of funding, 10 years of waiting. And then what happens to Jonathan here? When he's ready at 65 to retire, he is going to pull out $132,000 per year, tax-free, as a loan against the value of his contract. And he's not going to pay that loan back, ever. $132,000. He's going to be able to do that for 16 years, comfortably, without destroying his contract. Funding for 10 years, and then having 16 years of significantly more money being passed back to him, tax-free. Because that's what this contract can accomplish. So this is a personal pension. The money mansion evolves into a personal pension. And it can do so many things for you while you are waiting to get there. This is what I'm saying. The power of contracts is so massive and it's just not talked about. Because look, you had to sit through this entire video to really understand how to use this. It's not on a billboard where it just says, invest $1,000, get $1,100 back in 3 years. That's simple. What I'm saying is not. I get it. But when you really think about it, really is simple. I know it sounds a bit weird. But again, think about this. You've got an asset. Okay, you got a contract, we'll call it an asset. And the asset is an obligation, series of obligations to a major financial institution to build your wealth for you. And we told them we wanted these things. We wanted liquidity, so access to cash. We wanted it to only go one direction, so it only grows. We wanted to share in the profits of it as it was growing, as the company was growing. And we wanted to be able to make this a multi-generational design. Well, how does that work? Multi-generational means as I get older, when I die, this account, this massive account balance is going to be taken and paid to my children. That massive amount is going to be taken and given to them tax-free, quick. Don't have to go through courts, none of that stuff because it's in the contract. It's going to go right to them. Well, in the Golden Goose plan, what I expect to do is I will be taking out money every year so I can go live my life. Before my kids see the balance, my contract will pay out the loans as my parting gift to the world, erase that, and whatever's left over, and it will be millions, is going to go to my kids. That's it. Now, it's certainly a little bit more elaborate when you figure out the details and stuff. All entirely possible, all legal, all available. Just a matter of structuring the use of contracts to achieve these amazing results. One of the ways we are using one of our money mansion contracts is with the kids. My kids are going to be entering university soon and got to figure out how to cover all those costs. We've done the RESP thing. I've not been a big fan. I just don't like how rigid it is for the most part. I get the point. I think it's noble that we're meant to save for our kids. I just don't like the framework of that strategy. So what we're doing with our money mansion for our kids is we're adding fuel to that instead. We're adding fuel to our daughter's money mansions instead. And as that money mansion builds, because it's just a contract like the rest of these, as it builds, it's growing, it's growing, it's growing. I'm going to be accessing money to pay for the university. So let's just say in the first year, maybe my daughter needs $20,000. Perfect. I will access the money, liquidity, as a loan from that money mansion. Same time, the asset continues to grow. So I owe money, but it's continuing to grow. Now, I may choose to never pay back this loan, the next year's tuition as well. I may choose to never pay it back. As I just explained in the Golden Goose example, on my way out of the earth and out of this world, I will erase my loans because the account value will be so high, mathematically so high, I can erase that loan on the way out and leave my daughters that massive growth asset, erasing all the debt associated with it. Now, that's abstract. I get it. And it's probably a bit confusing. If you've got kids and you want to talk about this strategy for that, I'm happy to explain that to you on a call to make it more relevant to you. So what am I saying? I'm saying make use of the obligation advantage. Stop worrying about the markets. Stop thinking about when's the best time to buy. Stop thinking about ups and downs, comparing this asset to that asset. The assets don't generate the wealth for you. They create anxiety along with it. The asset and the return world is entirely based on hope. Who could have predicted Trump going crazy with these tariffs right now? Who could have predicted that? Nobody. No one in a 20-year long planning schedule did anyone consider that that's a realistic outcome. But these things happen. That's the point. The market has cycles. It goes up and down. When you're investing in markets, you are making risk available to your life. That's it. And it's not necessarily a bad thing because risk does pay off, but you will not be able to predict the results. There will be some anxiety along the way. I'm suggesting stop acting like an investor and start thinking in terms of contracts. Who can I obligate to give me the results that I want? Document those goals, and we can put that into contract and say, now it's up to somebody else to make sure that they do this for me. And you can do this in a very manageable win-win contract with willing partners. I understand this whole thing is a mind shift. And I continue to be blown away when I think about how this has existed for so long and how it hasn't been communicated to me in this manner for so long. So it's possible. This is actually what I do. I help people create these structures so that they can live this contract worry-free life. You don't need to do this alone anymore. You don't need to be responsible for the growth of your wealth. You could put it on to somebody else. Not a financial advisor, not an investment advisor. I'm not even talking about investing. I'm saying you can generate the results you're after using contracts, passing the obligation onto somebody else, a major financial institution, or several of them, in fact, because they all do this. We can make this happen for you with clarity and precision. All right, you should have done this. We all should have done this yesterday. We all can do this today. If you don't do this soon, the value of this structure, the highest value of the structure comes with time. You need time. The contract needs to survive for a good number of years for this to really see amazing multi-generational results. So you really shouldn't delay in having this discussion and learning more about this and exploring this option to see if this fits in your life. Now, not everyone can do this. I will admit. I wish everybody could. Not everybody can. These are contract. Like I said, it has to be win-win. So the partner we involve has to be willing to do this with you, which means we have to apply. We just got to talk to them, tell them a little bit more about you, what your goals are, and then see if we find a willing partner on the other side. My experience, it very much is often a yes, but it is not a sure thing. Not everyone's going to be a candidate or qualify for this. Those that do, their lives are changed. So is that you? Will this change your life? So again, what are the benefits of a contract? I'm saying I want contractual growth. I want it guaranteed. I want it to be tax efficient. I don't want to have to pay tax on the increase of the value. I need there to be a way to access money, liquidity. And I explain that through using it as collateral, right? Having a loan that is based on the value of my contract. I want to participate in the profits. I want profit sharing opportunities. I want legal protections so that no one has access to my contract. Nobody can sue me for my contract, for example. And I want this to be able to be a multi-generational framework. All of that in a contract. And all of that is entirely possible. I have 6 of these. I have a money mansion neighborhood, and you can too. It's not a difficult concept to integrate into your life. And it gives such clarity and such calm when you do this. All right, so what do you need to do next? I highly recommend getting a copy of this amazing, amazing book called Get Wealth Up by yours truly. It is available on paperback. It is available on audiobook, Kindle, ebook. I do think you will benefit. Now that you know all this, you'll benefit tremendously from understanding the ins and outs about how the contract works. If you want to skip that part and you just want to go right to speaking with me, I'm available to have a chat with you. I love talking about this. I love empowering people to figure out ways to make their futures super bright. I invite you to email me, donnie@mangosgroup.ca, and I can send you back a Calendly invite so we can get on a call and get to know each other. See if there's a way that I could help you achieve these amazing results.